All right, so let's kind of break down some of the stuff that Jeff Gundlach's talking about. Let's first start off with him saying that you should be holding cash. About basically a third of your investment should be in cash right now. Do you agree with that idea that we're going to see more pain to come and there'll be a better opportunity down the line?
We think there's going to be more volatility to come, but we would not be an advocate for going to cash or holding that amount of cash. We think that investors should have a balanced portfolio, diversified portfolio, and that's really served them well throughout this. When you look at how the bond market has done on a year-to-date basis, and even through this storm that we've had over the last couple of days, bonds have done very well. And so having an allocation to that, as well as having allocations to other asset classes, has really benefited you. So we would be counter to that thinking of being all in cash or all in the market.
All right, that's fair enough. But there's actually been quite a bit of volatility when it comes to bonds. So where's the attractive entry point, and what part of the bond curve are you talking about? The short end, the long end, the middle?
Well, you're spot on. I think everyone always talks about volatility in the equity markets, think, oh, stocks. But what we've seen just in the bond market of late, particularly just in the last couple of days where we had that reversal yesterday in yields, we would be leaning into the short end of the curve. We would also be leaning into more high quality and investment grade bonds, corporate bonds. We don't think you need to take on the risk exposures in high yield right now. Spreads have been widening, and we think that can continue through some of this economic uncertainty.
All right, so certainly a lot of economic uncertainty. And so you're another person saying you should look outside the U.S. for opportunity. I want to ask you, and I always ask everybody this, if the U.S. is going to slow down significantly, maybe even fall into recession, isn't that a bad, basically, omen for these other markets? Won't they eventually feel the impact of the U.S. slowdown? So why are these other markets so much more attractive as opposed to trying to take advantage of opportunities here in the U.S.?
Well, I think the reality is that the starting point matters. And so when you think about the starting point from a valuation perspective in U.S. markets versus international markets, is that the international markets were already undervalued as we went into this, while the U.S. markets were a little bit frothy as we went into this. And so while the economic growth prospect for, say, Europe and other parts of the international developed world may not necessarily be better than the U.S., they're starting at a point of really low valuations where the opportunity to get in may be slightly better.